South Korea ends 2017 crypto ban. What does this mean for Bitcoin and the global market? At the start of 2026, South Korea sent a powerful signal to the global crypto market by officially preparing to end its long-standing 2017 ban on institutional cryptocurrency trading. This move could fundamentally reshape not only South Korea's digital asset landscape, but also influence global Bitcoin demand, institutional confidence, and future regulatory frameworks worldwide. In this video, we are going to break down why South Korea reversed its stance, how institutions will be allowed to invest, what safeguards are in place, and why this decision could unlock massive capital inflows into Bitcoin and top cryptocurrencies. More importantly, we are going to explore the market impact of this shift and what it could mean for the next phase of crypto adoption. So, why did South Korea ban institutional crypto trading in 2017? And why reverse it now? Back in 2017, South Korea imposed a strict ban on institutional participation in cryptocurrency markets. At the time, regulators were deeply concerned about money laundering, market manipulation, and extreme volatility. Crypto markets were still young, poorly regulated, and dominated by retail speculation, prompting authorities to act conservatively. Fast forward to 2026, and the environment looks very different. The Financial Services Commission, or FSC, now recognizes that digital assets have matured into a global financial sector with clearer compliance standards, regulated exchanges, and increasing institutional legitimacy. According to senior FSC officials, updated guidelines are expected as early as January or February, officially reopening crypto markets to listed companies and professional investors. From a market perspective, this reversal signals growing regulatory confidence. When a country as influential as South Korea softens its stance, it sends a strong message to global investors that crypto is transitioning from a speculative asset to a recognized financial instrument. So, how will corporate investors be allowed to trade Bitcoin and crypto? Under the revised framework, legal entities will finally be allowed to engage in virtual asset transactions, but under clearly defined rules. These investments are intended for financial management and treasury diversification, not reckless speculation. This is a major shift because it legitimizes Bitcoin and crypto as part of corporate balance sheets. Companies will no longer need to route investments through foreign entities or offshore markets just to gain exposure. As a result, domestic liquidity could increase, strengthening South Korea's local crypto ecosystem. Market-wise, institutional participation typically brings larger capital pools, lower volatility over time, and greater price stability, especially for assets like Bitcoin, which institutions often view as a long-term hedge. So, what investment limits and safeguards are being put in place? To prevent systemic risk, the FSC is implementing strict safeguards. First, companies will be allowed to allocate up to 5% of their equity capital into cryptocurrency investments. This ensures crypto exposure remains controlled and does not threaten corporate financial stability. Second, investments will be limited to the top 20 cryptocurrencies by market capitalization. effectively filtering out illiquid or high-risk tokens. Lastly, all transactions must take place through South Korea's 5 largest regulated exchanges, ensuring transparency, compliance, and proper oversight. From a market impact standpoint, these rules funnel institutional money into blue chip cryptocurrencies, reinforcing Bitcoin's dominance while also supporting established altcoins. This selective exposure could widen the gap between major assets and speculative projects. So, why are stablecoins still under review? While progress is clear, stablecoins, especially US dollar peg ones like USDT, remain under discussion. The FSC has not yet approved their inclusion, citing concerns around reserve transparency, redemption guarantees, and systemic exposure. Draft guidelines were shared with a crypto-focused working group on January 6, continuing a phased approach first outlined in February 2025. This cautious stance suggests South Korea wants to avoid importing foreign monetary risk into its domestic financial system. For the market, this delay limits immediate institutional access to stablecoin-based strategies, but it also reinforces South Korea's image as a risk-aware regulator, which can actually boost long-term investor confidence. So, how much capital could enter the crypto market? According to Seoul Economic Daily, this policy shift could unlock tens of trillions of won in new capital. One striking example is Naver, which reportedly holds around 27 trillion won in equity capital. Under the new limits, the company could theoretically acquire around 10,000 Bitcoin. This level of institutional buying could significantly impact Bitcoin supply dynamics, especially given Bitcoin's fixed issuance. Even a handful of large corporations entering the market could tighten supply and support higher price floors over time. So, could this decision accelerate Bitcoin ETFs and industry growth? Beyond direct investments, allowing corporate participation may accelerate discussions around spot Bitcoin ETFs in South Korea. Public support already exists, but regulatory approval has lagged. Institutional access strengthens the case for ETFs by improving market depth and liquidity. Additionally, domestic blockchain firms, crypto startups, and digital asset treasuries could finally thrive at home rather than moving capital overseas. This could transform South Korea into a regional crypto hub, boosting innovation and employment. So, how does this fit into South Korea's digital finance vision? This policy aligns with South Korea's broader digital finance strategy. The government aims to process 25% of national treasury transactions through a central bank digital currency by 2030 as part of the 2026 economic growth strategy. The plan also introduces a stablecoin licensing framework requiring full reserve backing and legally guaranteed redemption rights. Together, these initiatives show a carefully balanced approach, embracing innovation without sacrificing financial security. And finally, my own personal opinion about this is that South Korea reopening its crypto market to institutions is a major bullish signal, not just locally but globally. While the safeguards may limit explosive short-term moves, they lay the groundwork for sustainable long-term adoption. Bitcoin stands to benefit the most, as institutions tend to prioritize scarcity, security, and regulatory clarity. If this model proves successful, other cautious jurisdictions may follow, making 2026 a turning point for institutional crypto adoption worldwide. And this finally ends our video. Thank you very much for watching and see ya on the next one.